If you're carrying a credit card balance and earning 2% cash back, the math is doing something to your money you might not be tracking. We're going to walk through exactly what and the spending pattern where rewards stop being a perk and start being a trap. By the end of this, you'll know three things. One, what your card is actually charging you, even when the statement looks fine. Two, the rewards versus interest line, the specific point where a rewards card starts costing you more than it gives you. And three, there's a single behavior at the end of this video that the highest net worth households I've seen all do. It's free, it's boring, and it's worth more than any rewards program. Stick around for that. Before we get into the math, one thing worth saying out loud. Credit cards are not inherently bad, and they are not inherently good. They are a tool. The same tool that takes $1,000 from a household one year can give that household $1,000 the next year, depending on how it's used. We are not in the camp that says cut up your cards. We are in the camp that says know exactly what they are doing to your money. Here's the setup. The average American household has about $7,200 in credit card debt, according to the latest Federal Reserve consumer credit data. Average APR right now is sitting around 22%, and the average rewards rate on a popular cashback card, let's call it 2%. Both numbers are real. Both numbers happen on the same card, in the same month, for the same household. Most people focus on the 2%. The 22% is doing more work. Take a household carrying $5,000 in revolving balance, spending another $2,000 a month on the card. That household is earning $40 a month in cash back. They're also paying about $90 a month in interest, give or take, depending on the day count. Net, they're down $50 a month. And the reward screen on the app shows a positive number, which makes it feel like a win. The dashboard isn't lying. It's just showing one side of the equation. Now let's get into the actual mechanic. Three things determine whether a credit card pays you or charges you: the grace period, the daily periodic rate, and the carryover rule. The grace period is the window between your statement date and your due date. If you pay your statement balance in full by the due date, no interest. None. The card is free money for that month. Most major cards give you between 21 and 25 days. Use it, and you're using the card the way it's profitable for you. The daily periodic rate is your APR divided by 365. If your APR is 22%, your daily rate is about 0.0603%. Doesn't sound like much, but here's the way to picture it. Imagine a bucket sitting on your kitchen counter. Every single day, a small drop of water lands in the bucket. One drop a day, you barely notice. By the end of the month, the bucket isn't empty anymore. There's water at the bottom. That's the daily rate. Tiny per drop. Real money by month end. About $3 a day on a $5,000 balance. $90 a month. Here's the rule that surprises people most. The carryover rule. Think of the grace period like a streaming service free trial. As long as you cancel, meaning pay in full, by the deadline, the trial keeps renewing. Miss it once, even by $1, and the trial gets revoked. New purchases start accruing interest from the day you swipe, not from the next statement. That means new purchases start accruing interest from the day you swipe, not from the next statement. The 21-day free window goes away until you pay the full balance for one full statement cycle and reestablish the grace period. Until then, every coffee, every gas fill-up, every grocery run is being charged interest from minute one. Let me run two real scenarios so the rule is concrete. Meet James. James spends $2,500 a month on a 2% cashback card, pays the statement in full every month, earns $50 a month in rewards, pays zero interest. Annual benefit, $600. James's card is doing its job. Now meet Maria. Same spending, $2,500 a month. Same 2% card. But Maria carries an average $4,000 balance, earns the same $50 in rewards, pays roughly $70 in interest at 22% APR. Net, minus $23 a month. Annual cost, $276. Same card. Same spending pattern as James. Different relationship with the grace period. Different outcome by almost $900 a year. Here's the threshold question. At 22% APR and a 2% rewards rate, The break-even balance is roughly equal to your monthly spending. If your average revolving balance is higher than your monthly spending, the card is costing you. If it's lower, the card is paying you. There's a graphic on screen with the math. Pause it if you want to plug in your own numbers. 3 cases where this rule changes. First, 0% intro APR offers. If you're on a balance transfer card with a 12 to 21-month no-interest window, the carryover rule is suspended for the duration of that promo. The card is genuinely free during that window, but only if you have a real plan to pay it off before the promo ends. The day after that window closes, retroactive interest can hit on some products. Read the promo terms. Some cards charge interest from the original transfer date if you're not paid off by the deadline. That's a different math problem entirely. Second, high rewards cards with annual fees. A card paying 4 to 5% in a category with a $95 annual fee needs you to spend roughly $2,000 to $3,000 a year in that category just to break even on the fee. Below that, the no-fee 2% card pays more. Above that, the premium card wins. Most households running a premium card don't hit the break-even spend in the actual category they got the card for. The category sounded good when they signed up, but the actual spending didn't show up. Third, welcome bonuses. A first-year welcome bonus can flip the entire calculation. A $200 cash welcome bonus on a $3,000 minimum spend over 90 days is essentially a 6.67% return on that spend, on top of whatever rewards rate the card pays. For year one, even a card with a $95 annual fee can be your top pick. The catch: this only works if your normal spending naturally hits the minimum. Without you forcing purchases you wouldn't have made anyway. The moment you're buying things to hit the minimum, the bonus stops being free money. It's just disguised retail therapy with a point sticker on it. The behavior I teased at the start. Every household I've looked at that's quietly winning with credit cards does the same thing. They auto-pay the full statement balance every month, not the minimum, not a fixed dollar amount. The full statement balance, automated, set up the day they open the card. It's not exciting. There's no app for it, no subreddit thread celebrating it. But it does 3 things. It locks in the grace period. Interest can never accrue. It removes the human decision of how much to pay each month. And it makes every rewards dollar real money instead of theoretical money. The only households I've seen consistently come out ahead on rewards programs do this. Everyone else is gambling that their cash flow will line up perfectly with their statement date, and over enough months it doesn't. One refinement: set the auto-pay date for 2 days after your statement closes, not on your due date. That gives you a 48-hour window to verify there is no fraudulent charge or statement error before the full balance pulls. Tiny adjustment eliminates almost every situation where you log in to find an unexpected $400 charge cleared 2 minutes ago, and now you're disputing it from a deficit position instead of a credit one. If you want to figure out which credit card actually fits your spending pattern without applying or pulling your credit, there's a 60-second quiz. Links in the description below, along with more videos like this one and the Monday Brief. Subscribe and hit the bell so you catch the next one. New episode every Monday, Wednesday, and Friday. If this one was useful, like and follow Wealth Unlocked. That signal is how the algorithm knows to show this kind of content to people it'd actually help. Quick note: everything in this video is for educational and entertainment purposes only. Always talk to a licensed professional before making decisions. The 60-second quiz, more videos, and the Monday Brief are all linked in the description below. See you in the next one.